Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
All right, everybody. It is 4:30 in New York. Thank you for joining us this afternoon, and welcome to the ISE webinar. Today's session will be hosted by Toni Hansen, who will be teaching us about price action in ETFs, reading price action in ETFs. Toni is one of the most respected technical analysts and traders in the industry, with a high reputation for accuracy in both bull and bear markets. She began her trading career as an equity swing trader and has since expanded into many other sectors of the market. Her style of trading and market analysis transcends time and market vehicles, making it attractive for investors and traders of stocks, futures, options, ETFs, and even the Forex market. I'm going to go ahead and turn it over to Toni, who's going to start us off this afternoon.
Hey everyone, can you hear me okay?
Yep, I think we can hear you. Can everyone else hear Toni?
What's that?
Yep, looks like everyone can hear you. Yep.
Oh, here we go.
All right, then we're all set.
All right, well, thank you guys for joining me today. I just got back from Dallas, so that was quite an experience. Had a good session there, a couple of things going on. Today's session we're going to talk about reading price action in ETFs. And for those of you that have been following a lot of my sessions over the years, we're going to be covering a lot of the core material that basically I use for my type of market analysis. Pretty much, I've been trading since, 1996, so quite a while here. Basically, online trading was kind of just becoming popular when I came onto the scene, and at that time there really wasn't a lot written about technical analysis and how to use actual price action through charting to read the markets. Now there's a whole slew of information out there, and it can be a little bit overwhelming, but you'll find that my style of analysis really focuses upon a lot of pure price type of action, where I really try to keep things like indicators to a minimum so that it doesn't really cloud your judgment like a lot of them can. I know when you use a lot of indicators, for example, indicators only work during certain circumstances. So even things like moving averages are not, I guess, a great thing to use in all markets. For example, when you're running into like a trading range type of market, the shorter time frames might not work as well. So you really have to kind of get to know indicators a very great deal if you want them to work in your favor. And so I found that really focusing upon price action was kind of more my style and more the thing that I wanted to do. And talking to a lot of the professional traders out there, you'll find that very few of them rely on a lot of indicators. They might have one or two that they like to use as confirmation type of tools, but they don't really focus on them to a great extent. So when we talk about looking at price action in ETFs, let's first go here and look at what the ISE has to offer in terms of ETFs. Now, exchange-traded funds were basically introduced in the 1990s, right around the same time that I started trading, and they were most commonly used to track a particular index in the market, such as the QQQ, which tracks the NASDAQ 100. They're similar to mutual funds, but they trade a little bit more like stocks on the major exchanges like the ISE, and they can be bought and sold throughout the trading day, as well as being sold short, as opposed to mutual funds, which are just traded at the close of the day. Now, the ISE announced a partnership with First Trust in 2007 to launch a couple of different ETFs based on the ISE's indices. And these partnerships continue to grow, so we have a total of 10 ETFs now on the ISE, and you'll find more information about some of them at the URLs that are posted here. Now, one of the things that you want to keep in mind when you're looking at trading a lot of these exchange-traded funds is that you want something that has a lot of liquidity to it, especially if you're trading short-term, because you want to be able to get in and out of a position relatively easily. So when you're looking at what the ones that the ISE has to offer, the Revere Natural Gas Index Fund is really the most liquid, and you'll find really strong trading patterns in it. A couple of these others here that are towards the top are also the ones that I really find the most favorable. So when you're looking through these are the ones that I gravitate towards, and you'll find that those are the ones that I'm using in the examples throughout this presentation. Now, if you guys have any questions as we go along, just feel free to post them in the Q&A box that you'll find over that lists all of the information for this session. And just go ahead and put them in there, and I'll take a lot of questions and answer them towards the end of the presentation. But I won't stop midway because we can often get overwhelmed and kind of run out of time, and I don't want to do that. So if you have any questions, just feel free to post them, and I'll be happy to go over them here at the end of the session. Now, my style of market analysis is one that I say that it relies upon the building blocks of price development. So it's a little bit of a new way to look at technical analysis and price development. Instead of focusing on things like core setups like a head and shoulders pattern or a bull flag, it's really looking at the elements that go into the development of these patterns, because it's how those core strategies that you're so used to hearing about form that really influence whether they're going to be successful or they're going to fail, and the degree of success that you're going to get in them. So when it comes to trading the ETFs, there's three main building blocks that I want to cover today. And the first one is going to be pace or momentum. The second one is going to be trend development or trend placement. And then we're going to look at support and resistance levels. Now, my key building blocks of price development, there's actually 5 of them. The 2 additional ones are going to be volume and correction periods. But if you go back and look at the archives for the ISE webinars, you'll find that I cover some of these in some of the previous sessions as well. So that would be a great place to look to start to get a little bit more information. And of course, you can always go to my website, which is tonihansen.com, and you'll find a lot of that there as well. Now, the first building block that we look at is pace, or it's also known as momentum, and it's a measure of the amount of time it takes for a security to establish a movement in prices compared to earlier price moves of the same amount. So basically, let's say we're looking at a period of time over 30 minutes, for example. Then what we want to see is how much price movement takes place within that 30 minutes. And then we compare that to the next chunk of time, the next 30 minutes. And we're looking for those averages. Hold on just a second, guys. All right, sorry about that. Didn't want to cough on you. Let's pull up the next slide. So this one we're looking at a template that I often use for discussing momentum or pace. And I'm actually going to pull up a marker here. And when we're looking at pace or momentum, let's say, for example, that this upswing here took about 30 minutes to form. This is going to be what we'll end up considering a stronger than average pace move. And what tends to happen is that when the momentum is stronger than average, you'll have a more gradual correction. And there's a couple of ways that this can form. Either it can form through a gradual pullback, such as we saw here, or we might see the pace of the rally begin to slow over time, so that there's a shift in momentum at highs where we actually have sort of a rounding off, or sometimes it can look even like a little bit of a boomerang type of action along the highs. But these are both ways that we can see this momentum begin to shift. And when the momentum slows, then you're more likely to get a stronger reversal type of action. So in D, for example, we have this slowdown in momentum where there's a slower pull higher, and this can result in this stronger push to the downside. Now, one of the questions that I often get is, how do you know if something is stronger paced or slower paced than any other time? And this is a really good question because a lot of people will try to focus on something such as reading the angles of these moves. And this really doesn't work very well because even if you're looking at like a 90-degree angle on one chart, if we squish this chart up, we're actually going to have a narrower angle. So you can't say, well, an average angle is 35 degrees or 90 degrees. You want to look at it in comparison to the previous price action. And often the way that I will do that is I will go back and look for these V sort of pivots that form within a security. And oftentimes when you're seeing that, this gives you an idea of where the average move is going to be. The downside and the upside on one of those V's will be approximately an average paced move. Now the ones on this one will be probably considered a little bit stronger than average because we're going into this trading range, but in general that is the best way that I have found to give you a better idea of where you are really looking at it as a stronger or slower paced move. And we can see that in this congestion here, if we look at this, we actually have a sideways trading range right here. And overall, the momentum has now shifted to a slower sideways move. We'll go back to this here in just a minute. But within this trading range, the momentum shifts once again so that we have this slower move on J to the upside, which leads to a faster breakdown on K. I'm going to actually switch to the next slide and show you these in a little bit more detail. So basically, when you're dealing with a slower than average move, it's often going to correct with a stronger price move. Now here's that V type of action I was referring to. In this case, we have an inverted V. So each of these sides would be giving us that baseline for what an average paced move could be. And here we have a slower move in A, more gradual. And if you were going to add volume to the equation, you would typically see volume declining or flatlining as it is forming this more gradual move. And that often adds additional confirmation that you're going to get a breakdown. So with the slower move, we have a higher chance that we're going to get a stronger move to the downside. Now, where this comes into play is when we're looking at the individual strategies, such as this here. This is a head and shoulders type of pattern. Now, we've increased our odds dramatically on this being a successful head and shoulders pattern, where here is our left shoulder, here's the head, and here's the right shoulder. We've increased our odds on this being a strong, favorable strategy because of the fact that A is substantially slower than average on the upside. Now, if this had rallied to a greater degree here, such as here, still putting in a lower high on this right shoulder, we would actually have a higher risk setup because there would be more of a chance that when this pulled down here, it would come into support at this previous low and have some sort of reaction off of it. It might bounce. It could even turn back around on us and end up forming a larger continuation pattern on the upside. The fact that the momentum is actually slower here, though, makes it less likely that that's going to happen. Now, on the other hand, if we have a slower than average move and then a faster than average move, we have a higher chance that we're going to get a more gradual correction, such as a bull flag forming in the case of this breakout from this triangle here. So you'd have a stronger chance of getting a successful strategy on the upside. And once again, with the lighter volume or with the lighter pullback, you'll often have lighter volume as well, whereas volume will tend to be stronger on the stronger paced moves. And that, again, offers additional confirmation. When you have the start of a trend shift where, let's say this was a strong uptrend here. And then you see this V form at highs. If you have a similar paced move, one to the upside followed by one to the downside, or vice versa, and it's that first initial V type of pattern or inverted V type of pattern, you're more likely to have a security that's going to be falling into a trading range, which you can see happen here. So with this initial inverted V, coming back into this support level over here, that tells us that we're more likely to see some sort of trading range or longer-term congestion form following that secondary pullback here. And oftentimes, this previous high zone is going to serve as a resistance level. And we'll talk a little bit more about support and resistance here in a little bit. Now, you don't necessarily know how long this congestion is going to last just based upon that initial inverted V here. It could go into a head and shoulders pattern and head lower where the longer period of congestion only lasts until about here, or it could lead to an even more substantial trading range such as we saw here with several highs and several lows until some point that the momentum once again shifts and gives us a stronger bias. Whenever you have any sort of a trading range, you're always going to increase your odds of success if there is a shift in momentum within that entire range itself. And this isn't always going to happen. A lot of times you might get it where it just comes back to the upper end of this trading range and pushes right through. What often happens is that this can be more of a trap. So you'll have a breakout from that trading channel, and then it will pull back into it. And sometimes it will be enough of a pullback where you might get like a two-way correction, and it can take out your stops from under that trading range and even turn around and head higher once again. So the stronger odds of success are going to come when you actually have a shift in momentum within that trading range before a breakout kicks off. Now let's look at how to measure these changes in momentum. One of the first things that you want to look at is not so much what a lot of these shorter term movements might be, but what the overall channel of price development is. So we might have a strong upside move to begin with, but then the momentum might shift, and we'll see a slowdown where even though each of these higher highs is established by a momentum move that seems to be similar to the previous one, if we actually connected the highs and connected the lows compared to doing the same thing over here, we would see that the momentum has shifted. So when I'm looking at pace, I want to transect, or basically cut in half, those trend channels. And we can see an example of that here from the recent action we saw in this natural gas ETF, where we have transected these moves to the upside and downside, and you can see very clearly where our momentum is shifting. For example, here's another here's a template we were looking at earlier, and you can see that shift in momentum on D here, very similar to the shift on C up here, where we had that slowdown, and it follows with a stronger than average move on the downside. And we say stronger than average because when we look at this over here, hold on a second, we have this high and this low compared to this. And if we connect these, you can see we're getting this V sort of action. But this pullback here is stronger than each of these sides on these V type of pulls. So we've got a stronger than average move now on the downside. And even though this rallies to a large degree where we almost have a double top, the momentum is still more gradual on E than it was on D. So that still gives us the strong potential for a sharper breakdown, which we saw here on F as this pulled back into that 100-day moving average. And here, another shift in momentum where we have a slower correction as a result of this fast drop. It almost tried to start to change that momentum by putting in a slightly lower low, but it didn't manage to really put in a slightly higher or a slightly lower high that would shift it to a greater degree. But we did start to see it attempt to shift the momentum here. But this was still a slower upswing, so we still had a pretty rapid downside move, although not to the same degree that we saw on F. Now let's look at a couple of other things that are going to help go into reading price development. And the next thing is going to be trend development. And oftentimes a trend follows a really clear and concise pattern of development. And if you understand where your setup is taking place in the larger trend, that's going to give you an indispensable odd in your favor as far as whether you're going to see a successful strategy and what your risk is going to be on that strategy. Now, trend development and pace or momentum are really the two most important building blocks in price development. If you have these two things in your favor, you can have the other cons and still have a very successful trade. Most of my trades that I end up taking a loss on, even if everything else is lined up, and the only con I had was trend placement or pace, that can ruin the entire setup. Whereas you might have volume against you, you might have correction periods against you, but if you've got the pace and the trend placement in your favor, you have a higher chance of success. And I go into these in a lot more detail on my course that's the 5 technical signals you should not trade without. It really goes into each of these 5 building blocks. And you can learn more about that again on ToniHansen.com, or just email me if you have any questions. Basically, we're looking at these really simple components of price development that go into every strategy that you're trading, but they can really make or break a setup. We're looking at trend development. You know, one of the most popular types of trends that you're going to see and templates that you're going to see is this 3-wave pattern here, where we have these 3 pushes to the upside. And Elliott really made this famous, but there's a number of people that even before him really stumbled upon this, and it was something that I stumbled upon as well before I got into actually studying technical analysis. So you're going to find that this is something that has really gone back to kind of the very start of technical analysis, and it continues to hold true to this day, where oftentimes, if you have a new trend and you see these 3 waves of upside, that tends to exhaust the trend. Now, the key, though, that I noticed was what happens in between each of those 3 waves of upside. And this is really important. These are most likely to hold that 3-wave trend when each of these correction periods is comparable. So if this correction between 1 and 2 lasts about half an hour, you want to see the correction between 2 and 3 last half an hour as well. If there's a larger difference, more than, say, 5 minutes or so, then you might get 4 waves or 5 waves of upside, but each of these will have different amounts of time between them, each of these corrections. And that's where you'll get a trend day that just seems to keep going and has more than those 3 waves of buying or 3 waves of selling. Now, momentum is something that comes into play with these, because if we have a situation where the strongest momentum is on this first rally, we might see a slowdown in momentum on a second rally, and an even slower push to highs on the third rally. So now we not only have trend development in our favor with 1, 2, 3 highs, but we also have pace or momentum in our favor because momentum is slowing on the upside, which shows us that there's a higher chance that we're going to have a very strong reversal on the downside. On the other hand, if what we saw was a slower start to a trend, a little bit of an increase in the momentum on the second move, and then a really strong push for the third wave higher, you're going to have a really difficult time seeing any strong follow-through on the downside, particularly immediately. If it does push and form a V high, a lot of times that's just going to lead to a longer trading range, and it might act as a reversal later on, or it could just turn into a longer uptrend. So you really want to be careful in terms of looking at trend exhaustion, trend placement in terms of your pattern development, as well as what's going on the momentum side of things within these trends as they're forming.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.